I'm Ian Castle, founder of Microcap Club, home to the best microcap stock pickers on the planet. Since 2011, our members have profiled over 1,300 microcap companies, with over 290 turning into multi-baggers. That's more than one big winner every single month for 14 years. If you share the passion for finding great companies early, before Wall Street and the institutions, Microcap Club is where you belong. Join us.
And joining us from Cormark to give his pitch is Kyle McPhee.
There it is. All right. Hi, everyone. I'm supposed to give a disclosure to start, just to disclose that Cormark's an investment bank, and the company I'll be talking about today is an investment banking client of Cormark Securities. So I'll be talking about Zedcor, among the smaller companies that I cover from a research perspective at Cormark Securities, where I've been working for coming up on 15 years. This is one of my favorites among the smaller ones. It's a pretty impressive earnings compounding type of business. It has all the hallmarks of durability, resiliency, even accelerating compounding momentum is what we've been seeing recently and will probably continue to see. The stock's been on a tear to the upside recently, but I wouldn't let the stock chart scare you here. It's not over. There's a lot more growth left, and the valuation from a fundamental perspective is not really ahead of itself yet. So there's lots more to go. To start, the simple stuff. What do they do? So this is a service company, specifically security services. Even more specifically, they're in the niche of live monitored, remotely administered security surveillance. Now, I've underlined a handful of words on the slide for a reason. These are some kind of key things to drill in on. I underlined the word service. This is not an equipment rental business. This is not a commodity equipment rental. This is a service business, and that's important to realize, because if you can nail the service and you can nail the relationship with the clients, then you can keep your clients sticky. Investors that are kind of missing this one and kind of haven't wrapped their heads around it yet still think it's kind of a commodity equipment rental business, but it's not. It's a service business. There's a lot of back and forth service points with the clients, from the initial setup of these towers at the client sites to the ongoing monitoring, the ongoing reporting with the client, and sometimes investigative services with these clients. So this is a service business. I've also underlined live monitored. So this is not just cameras passively collecting footage, getting stored in the cloud, and people can choose to access that footage after the fact. This is streaming cameras being live monitored. The point is to catch bad actors in the act in a preventative manner. Again, not just collecting footage. This is live monitored using cameras that are remotely being watched. I've also underlined AI-enabled streaming cameras. So this is the key. It's not their technology. They're using all third-party parts and technologies here, but this is the key technology they're using, AI onboard the cameras, that allows this business model to be economic and scalable. The whole point is to have a very few amount of humans monitoring a very large amount of cameras. And the ratio right now that they've actually attained is like 1 to 200. One human can watch about 200 cameras at a time, because the AI cameras are filtering out what needs to be responded to by a human and what does not need to be. So for instance, if a camera's watching a construction site after hours and an animal runs through it, or a bag blows through the site, the camera knows what it's looking at. It's not going to trigger alarm that needs to be investigated by a human. Only real kind of validated alarms need to be investigated by a human. So that, when the emergence of this technology over the last recent years has allowed this business model to emerge, and that's why it's such a white space theme. It's now a scalable economic business model, very economic, as we'll get into. What else have I underlined here? So owned and operated central monitoring. I've underlined that because that is the heart of the service. This is driving the service quality, how good their service is for clients. Zedcor is very committed to never outsourcing this key function, never offshoring this key function. There's a couple other big players in the space that offshore and outsource it, and they're kind of dropping the ball on service quality and that back and forth communication and relationship with the client. So Zedcor keeps that all internal. It's their own staff they hire and they train, and that monitor all these cameras domestically for Zedcor in their own monitoring center. I've also mobile and self-powered I underlined. So I put an illustration of these towers on the slide here. These are self-powered, diesel with battery, solar with battery, and connectivity is cellular and satellite. So they can be deployed anywhere, and the way these are constructed ends up meaning they tend to be used in outdoor applications. I've listed a lot of end markets that are using this type of service, increasingly using this type of service. And it's also worth pointing out these are, the service tends to be permanently deployed at a client site, or in some of these categories, you can probably figure it out, they're moving site to site with their clients. So that's basically what the business is in a nutshell. At the top of the slide, I say the reason to own the stock. And the reason to own this stock is because it's a compounding business model with a lot of durability to it, to continue doing the same thing. So what's driving this durable compounding? Well, the first thing is they keep scaling their service capacity. So their service capacity is their fleet of towers. Essentially, they build a tower. This is all third-party components. They self-assemble it themselves at a facility in Texas. They started doing that in 2024, and that really de-bottlenecked their supply chain for them. One of the reasons that we're seeing accelerating growth now. But they build a tower, they deploy it to a client site. It's immediately generating high margin cash flow for them. They take the cash flow, they reinvest it in building more towers, just continuously expanding the service fleet. And to kind of unshackle themselves from the growth rate they can attain from just their cash flow, because there's a lot of cash flow, they can borrow against that cash flow. Lenders readily give them capital to borrow against their cash flow, and then they can also access equity markets as desired to grow even faster and pull forward the demand capture. As we'll talk about a bit later, there's a lot of white space in this sector. This is a relatively new niche in the physical security services market. So the idea is go out, grab the demand as quickly as you can, and do it right and keep your clients sticky over time. So I like to see them pulling forward demand capture by using debt and equity, using it responsibly. So there's some illustrations. These are bar charts of their actual quarterly performance from 2021 through to the most recent quarter. So you can see over the last year and a half or so, they've really started accelerating growth. That's a few things. One was they debottlenecked their own supply chain. Another thing was they debottlenecked their balance sheet with accessing equity a couple times to really pull forward demand capture. And then also they entered the US market in 2024. Before that, it was just in Canada. So they've really kind of expanded into a much bigger addressable market, and they're capturing demand very successfully. So top left, you see them sinking growth CapEx in fleet expansion at an accelerating pace. Below that, bottom left, you see the amount of towers they're adding every quarter keeps going up and up. And then the cumulative tower count is there on the bottom right. And balance sheet in a great position right now after the equity raises, under-levered versus where they were historically. So that's one main thing driving the earnings compounding here. They're just continuously expanding their service capacity at an accelerating rate. That's great, but is that actually translating to scaling your financial profile as well? Your revenue, your profits, your actual free cash flow that matters the most, your cash earnings. And the answer is yes. You can see it on this slide. So top left is the revenue. As they build these towers and deploy them, they're all getting utilized because they're in such high demand. Anything they build flies off the shelf. So revenue is scaling with fleet capacity. They are now very diversified by end channel, by client type. That wasn't necessarily the case 2023 and earlier, and you can see back then, late 23, there actually was a blip in revenue momentum. That was before they were very diversified, very exposed to a couple big pipeline construction companies that were their original clients. The multi-year construction projects ended, and there was a little bit of churn on repatriating the towers and then redeploying them with new clients. But now since they've entered the US market over the last year and a half or so, they don't have that kind of client concentration anymore. So it's great. You're scaling service capacity, you're scaling revenue, you're also scaling your profits, and you can see top right, the EBITDA chart there. They definitely are. This is a very profitable business. Not much costs are left when you drop the tower off at a client site, other than the centralized costs, and we'll get into some of that type of stuff, but this is a low to mid 30% EBITDA margin business that they're generating when they drop these towers off. There are, as you can see in the top right chart there, some periodic rounds of volatility for margins. That is just them going out and spending on growth. On growth at the OpEx level. So opening new branches, opening up new regions, hiring more salespeople in the US, and obviously the costs hit before the revenue hits. But then they leverage into the new costs, and profit dollars are definitely scaling higher with revenue. Even more important than the EBITDA level is, are you actually making free cash flow? And that's the bottom charts here. So their free cash flow is actually very high conversion of EBITDA into free cash flow. It's about 70 to 75%. I'll point out that there's very minimal CapEx for this business model. All of the CapEx that you're going to see on their cash flow statement is growth CapEx to expand the fleet. Most of the maintenance spend to maintain these tower units is expensed above the EBITDA line. So very high conversion to free cash flow. And then even more important, are you making free cash flow per share? And they definitely are. So they've done a couple equity raises, but the free cash flow, it's all for good reason. The invested capital is generating good returns, so they are expanding and compounding their free cash flow per share. Exactly what we want to see. So they're scaling their service capacity, they're scaling their financials, including that key free cash flow per share number. What's powering all this? At the root of all this is the unit economics, the financials basically per tower. And it's very attractive unit level economics, and it's been getting better, directionally better. I've broken down on the left there basically the key inputs that are impacting the unit level economics, and we'll quickly go through them. So the upfront CapEx, how much does it cost to build one of these towers? It's actually prevailing for them right now at about US $20,000 per tower. That's come down a lot over the last year or so, and that's a function of their scale, their procurement scale. As they're buying more of these components from the suppliers, they get better terms from the suppliers. And even more important, as I said earlier, they're self-assembling these towers. They're now, because their throughput keeps climbing, they're getting more efficient with it, better labor utilization. So their CapEx has been coming down per tower. I would bet that going forward, that continues with scale. So one of the benefits to scale in this security service niche. Service pricing, obviously key to unit level economics, the key determining factor on what type of return on capital you're going to get on this upfront CapEx. That has also been trending up recently. They have auto escalators at contract anniversary dates with these clients, but also just they're currently priced below the other major peers in the space. So they've been raising their pricing. There is a question mark on what that looks like forward. My guess is this business model will have pricing power. Supply doesn't exist without the price that justifies the upfront CapEx. Clients are getting a return on the cost of this service. And the substitute is basically a more expensive and often less effective human guard. So that helps with pricing power. Fleet utilization, I'll go through some of these real quick, but it's basically very high right now. At maturity, when there's a lot more fleet and there's natural churn between moving these around from client sites, that'll come down a bit. And just to kind of direct OpEx is stuff like staff deploying these towers, maintaining the towers, the streaming costs of the cameras. That stuff's basically been scaling one-to-one with the fleet. I bet they get some economies of scale over time, especially down in the US where it's relatively less mature for them. And then there's OpEx leverage coming for the indirect costs. That's been going the wrong way recently, but that's just the growth spend, them opening up new regions. But they'll leverage all that. So right now, my best guess, based on everything I know, is the upfront CapEx is generated for these fleet units is generating about a 20 to 25% after-tax IRR, and that's fully loaded, accounting for the full maintenance spend you need for these towers over the life of a tower. Getting tight on time here, so I'll probably have to go fast here, but everything I just talked about sounds great, but how much longer can they do this before they run out of big growth runway? And I don't think they're going to run out of growth runway anytime soon. I list some of the reasons on this slide, but one big main one, this is a big market. Physical security services is a $35 billion market in Canada and the US, and they are kind of a niche of that, a very white space and disruptive niche of that. The disruptive part is displacing way more expensive and often less effective human guards with these cameras. About 1/3 of the towers Zedcor's deployed have just simply displaced a human, and then white spaces, these are remote, outdoor, unconnected areas with no power where there was no solution, and now they have a solution. So those themes, I think, have many years of runway left. They have no supply chain bottlenecks to grow faster with their suppliers or their current assembly footprint. Their balance sheet and access to equity is definitely not a bottleneck, and they're starting to emerge as one of the big players in this niche that can do business with the big national enterprise type clients. You want to be a scaled player to be able to capture kind of that pocket of demand. So how much more are they going to grow? That's a big question mark. On the bottom right in that purple box there, I put my best guess for now. There's a lot of estimates floating around the street. Some are huge, some are thin, some are based on fluff. I try to root it in something real, whatever I have access to right now. I look to their most mature Canadian cities that have been around for multiple years, where they're still growing, but they've kind of got closer to maturity, closer to the mature penetration. And if I apply that penetration rate to the top 30 cities in Canada and the US, you get an implied number of about 12,000 towers is something they could get to. Now, there's lots of give and takes. We don't have time to go through the problems with this approach, for better or for worse, but the point is they probably get to a fleet that's going to be multiples of where they are now. They're at 2,000 right now. So to wrap up here, I mean, this is the stock chart. As I said earlier, it's been on a tear higher, but it's not just based on hot air. This has been following all those other charts that I showed you earlier look like this stock chart. The stock is moving with their cash earnings per share that is trending higher and higher, and it's still not overpriced from a fundamental valuation perspective. You know, it's a mid to high single digit cash earnings yield, maintenance free cash flow yield, whatever you want to call it. That is definitely not ahead of itself for how many years of growth runway they still have ahead of them. And I see two outcomes probably happening here. One is they keep compounding cash earnings and then eventually use that for something else, as I kind of described bottom right. But the more likely scenario is I bet this company just gets taken out. There's a big list of logical buyers for this type of business. Private equity, the human guard security companies like Garda, who have already started acquiring in the niche, other strategic companies like equipment rental businesses, and maybe even the other two big players that are in this niche. So yeah, and just to cap it off, management insiders own 30% of the stock here, so they're aligned with you if you own this stock. That's it. I think I went over time a bit, sorry.